Warren Buffett gets paid $100,000 a year. Mark Zuckerberg takes a $1 salary. Elon Musk went multiple years at Tesla, making exactly $0, and yet somehow they're living in mansions, flying private jets, and funding billion-dollar ventures. So how is that possible? The answer is something the ultra-wealthy have been doing for decades, something they never talk about publicly, and something that once you understand it, you'll never look at wealth the same way again. It's called borrow until you die. And today, I'm breaking down exactly how it works. Here's the dirty little secret about how wealth actually operates in this country. The system isn't designed around earning money. It's designed around owning assets, and there's a massive difference. When you work a job, even a really good job making six figures, you get taxed immediately. The IRS takes their cut before you even see that money hit your account. You're in the highest tax bracket, potentially losing 37% to federal taxes, plus state taxes, plus payroll taxes. By the time you actually get to spend your own money, you might be left with only 50 or 60 cents on every dollar you earned. But billionaires? They've figured out how to opt out of this entire system. They don't earn income in the traditional sense because income is the enemy. Income gets taxed. So instead, they build wealth inside assets, stocks, real estate, businesses, and they never ever sell. Because the moment you sell an asset that's appreciated in value, you trigger something called a capital gains tax. And that's exactly what they're trying to avoid. Let me give you a concrete example. Let's say you buy a house for $400,000. Over the next 5 years, that house appreciates to $500,000. You've gained $100,000 in value, right? But here's the key. That gain only exists on paper. The IRS calls this an unrealized gain, and as long as you don't sell, you don't owe a single penny in taxes on it. You could own a property worth $10 million that you originally bought for $1 million, and the IRS doesn't care. They only tax you when you sell and realize that gain. This is called the realization principle, and it's baked into the US tax code. According to IRS guidelines, capital gains are only taxable upon the sale or exchange of the asset. This creates a loophole big enough to drive a Bentley through, and wealthy people have been exploiting it for generations. But here's where it gets interesting. If billionaires never sell their assets, how do they actually fund their lifestyles? They're not living off a $100,000 salary. They're spending millions. The answer is debt, and not the kind of debt you and I are used to. When a regular person takes out a loan, it's brutal. You walk into a bank, fill out paperwork, get your credit checked, and if you're approved, you're hit with interest rates of 6, 7, maybe even 18% on credit cards. Then you spend the next 30 years paying back that loan with after-tax income. Let's say your mortgage payment is $1,500 a month. To cover that, you actually need to earn over $2,000 before taxes. So you're getting squeezed twice. Once by taxes, once by interest. But when a billionaire walks into Goldman Sachs or JP Morgan, it's a completely different conversation. They're not asking for a consumer loan. They're using something called a securities-backed line of credit, or SBLOC. Here's how it works. Let's say you own $100 million in stock. You walk into a private bank and say, I need liquidity, but I don't want to sell. The banker evaluates your portfolio and offers you a loan worth 50 to 70% of your holdings. So you walk out with $50 million in cash, and the bank charges you maybe 2 or 3% interest annually. That's $1.5 million a year in interest payments, which sounds like a lot until you realize your portfolio is probably growing by 7 to 10% annually. So your assets are increasing in value faster than your debt is costing you. Borrowed money is not considered income by the IRS. According to IRS publication, loan proceeds are not taxable because you have an obligation to repay. So that $50 million you just borrowed, tax-free, no capital gains, no income tax, nothing. You can use that money to buy more assets, fund your lifestyle, invest in businesses, whatever you want. And because you're using debt instead of selling, your original assets stay intact, continuing to grow in value year after year. This is the magic of leverage. You're turning paper wealth into real spending power without ever triggering a taxable event. Now let's say you take out that $50 million loan and spend $5 million on lifestyle, homes, cars, travel. You invest $20 million into new ventures. And you buy another $25 million in real estate. That real estate appreciates over time, maybe doubling in value over a decade. Now your net worth has exploded, but you still haven't paid taxes on any of it because you haven't sold anything. And when your loan comes due, you don't pay it back with cash. You refinance it or take out a new loan against your now even more valuable assets. You're essentially rolling debt forward indefinitely, using appreciating assets as collateral. This is why billionaires can live like kings while reporting almost no taxable income. They're not avoiding taxes illegally, they're using a completely legal structure that most people don't even know exists. And banks love this arrangement because wealthy clients are low risk. When you borrow $100,000 to buy a house, the bank sees you as risky. You might lose your job, you might default, but when someone borrows $50 million against a portfolio worth $100 million, the bank knows they're getting paid back. The collateral is rock solid, so they offer lower interest rates, better terms, and VIP treatment. But here's where the strategy gets truly insane. Eventually, everyone dies. And when a billionaire dies holding all these appreciated assets, something remarkable happens. It's called the step-up in basis, and it's one of the most powerful wealth preservation tools in existence. Let's say your grandfather bought Apple stock in 1995 for $1 million. Today, that stock is worth $50 million. If he sold it while alive, he'd owe capital gains tax on that $49 million gain. At a 20% federal rate, that's nearly $10 million paid to the IRS. But if he never sells and instead holds that stock until death, the cost basis resets. Under Section 1014 of the Internal Revenue Code, inherited assets receive a step up in basis to their fair market value on the date of death. So when you inherit that stock, the IRS treats it as if you bought it for $50 million, not $1 million. If you sell it the next day, you owe $0 in capital gains tax. Decades of appreciation wiped clean, tax-free. And what about all those loans your grandfather took out? In many cases, wealthy families use life insurance policies held in irrevocable trusts to pay off the debt upon death. The insurance payout clears the loans and the heirs receive clean, unencumbered assets. The wealth transfers seamlessly to the next generation and the cycle starts all over again. This is the buy, borrow, die strategy. Buy appreciating assets, borrow against them to fund your life without selling, die, and pass those assets to your heirs tax-free with a stepped-up basis. Rinse and repeat across generations. It's a wealth-building system so powerful, so embedded in our tax code, that it's essentially created a permanent ruling class. Families that master this strategy can compound wealth indefinitely without ever hitting the tax reset button that regular people face every single year. And here's the truth most people never hear. This isn't some shady offshore scheme. It's not illegal. It's how the system was designed. The tax code rewards ownership over labor. It rewards patience over quick profits. And it rewards understanding the rules over just working harder. For decades, this game felt inaccessible. It seemed reserved for people born into wealth or lucky enough to take a company public. But the reality is, anyone can start playing this game. You don't need $1 billion, you need assets. You're playing the same game the ultra-wealthy play, just on a smaller scale. The difference between rich and poor isn't intelligence. It's not hard work, it's understanding the rules. And the biggest rule of all is this: selling equals taxation. The moment you sell an asset to access its value, the IRS takes their cut and you start over. But if you borrow against it, you get liquidity without the tax bill. Your wealth keeps compounding, your assets keep growing, and when structured correctly, your heirs inherit everything with a clean slate. This is the invisible operating system, and now you've seen it. The question is, what are you going to do with this information?